Hi and welcome to Swiss Codes Daily Market Talk. It's Friday, January 17th. The sell-off in developed economies' bond market slowed yesterday and later improved appetite for many sectors along with some encouraging earnings on the wire. The European stocks, the bank and energy-related names are on the rise these days, while the US big technology names couldn't enjoy a rally yesterday, and that despite the strong TSM results. So optimism yesterday could have been better or bettered by slower than expected retail sales data in December, another set of strong bank and TSM earnings, and also some hawkish comments from the Federal Reserve's Christopher Waller, who actually said that he sees multiple rate cuts from the Fed in 2025 and a rate cut sooner than market is pricing if of course inflation continues to trend lower, which appears to be his base case scenario. But a quick glance at the inflation metrics in the US confirms the worries that we have today regarding the US inflation's trending lower, but trending lower at a relatively slow speed. Because energy and goods inflation looks to be under control right now, but the core services inflation remains pretty sticky. And Donald Trump's tariff threats and his plans to jolt the energy space across the world with further sanctions against oil-producing countries like Iran, Russia, and Venezuela threaten to maintain the upside pressure in oil prices this year, which is also positive for inflation. Now, although Donald Trump explicitly wants to finish it with the war in Ukraine, well, members of his new administration say that they will be supporting further sanctions against the Russian oil giants. And on top of it, well, Trump will be tightening his grip on Iran, apparently against its nuclear work. And he is also looking to punish Venezuela for its anti-democratic turn. So US crude eased yesterday as hitting the $80 per barrel psychological mark somehow encouraged many traders out there to realize their profit. But crude is better bid this morning again on good news from China this time. And while closing this week above the $80 per barrel psychological level could eventually give investors another incentive to stick with their bullish bets in crude oil. Especially if China optimists join the party. So in China, against all odds, the Chinese economy improved in the final stretch of last year and managed to hit the 5% target in inflation-adjusted terms last year. But the country has been in deflationary situation for the second year in a row. And retail sales there expanded just 3.5% versus a 5.8% advance in the industrial production, as obviously industrial production is easier to boost with the government stimulus measures than consumption, which demands some confidence. But consumption is the end goal for a healthy economic growth, and China is not there just yet. Anyhow, the CSI 300 index in China looks better a bit today than it did for the past 2 weeks of the new year. The yuan is slightly higher against the US dollar, but the Chinese 10-year yield still remains under pressure. Now, speaking of yields, the selling pressure in US and European Treasury markets slowed at yesterday's trading session, That was partly on the back of some dovish comments from some major central bank members, and it was also partly due to a technical correction after days of dumping these government bonds. So the US 2-year yield slipped below the 50-day moving average, and the 10-year yield fell to around 4.60% level. The British 10-year gilt yield retreated for the second straight session, letting the British government breathe a sigh of relief, really, especially after yesterday's GDP data from the UK show that the British economy hasn't expanded at all under the new Labour government, which had promised good growth. So the think tank of Labour circles accused the Bank of England for this slow recovery in economic growth, saying that They are putting the country's prosperity at risk for no good reason. This is what they said. Well, they must have missed the inflation spiking past the 10% mark in summer 2023 in the UK. But anyway, well, cable actually managed to recover losses and return to the 1.22 mark yesterday, but the pair is under pressure again this morning. While in Europe, the euro dollar remains offered between the 103-103.50 range as yields in Europe retreat from the early week peaks as well, and that's also explained by a global correction across the sovereign bond papers. But the narrative of exploding debt levels for these developed economies at both sides of the Atlantic Ocean, a possible U-turn in the inflation trends, and political worries remain the major drivers of market sentiment, suggesting that the bond sell-off that we've been seeing since a couple of weeks may have further room to run, and the yields are more likely to settle higher than their post-global financial crisis levels. And that's an expectation that obviously weighs on risk appetite globally. And that's maybe why the equity traders' reaction to softening yields yesterday wasn't unified. The European equities rallied, for example, and they rallied on the back of softer European yields and AI optimism following the TSM results of yesterday. ASML, for example, jumped nearly 5%, and the European stocks were also boosted by a rebound that we saw in the luxury stocks as the Swiss Richmond jumped nearly 17% yesterday to a record high level on double-digit sales growth in the fourth quarter, giving hope that the holiday season of last year may have been, or maybe prosperous for other luxury names as well, like Louis Vuitton's LVMH and Hermes. So LVMH jumped almost 10% yesterday to above its 200-day moving average, and Hermes closed nearly 5% higher at a record high. But the German stocks saw less enthusiasm among the European stocks, although the DAX index was also pushed to a fresh record high as well yesterday. In the UK, the FTSE 100 gained more than 1% as energy, mining stocks, banks, and real estate stocks there advanced on the back of these rising energy prices, and also on the back of more dovish Bank of England expectations following a softer than expected set of inflation data this week, and also a softer than expected growth data. As such, the US traders took over a cheery session, but the cheerfulness quickly faded there because despite softer yields in the US as well and the appetizing TSM earnings, the builder of Nvidia and Apple chips actually remained short of breaking a all-time high level in New York trading yesterday. So Nvidia fell nearly 2% at yesterday's trading session as worries that the new chip curbs toward China could weigh on its activity, along with the earlier news this week of delays in chip deliveries towards customers and some order cuts. So together, the Magnificent Seven stocks retreated nearly 2% yesterday, while the bank stocks advanced on the back of another set of better than expected quarterly results from big banks, because Morgan Stanley's profit more than doubled in the fourth quarter of last year, while Bank of America's investment banking fees hit the highest levels in 3 years. So all in all, the US big banks announced a blowout fourth quarter, and they actually show that they deserve their overperformance on the rest of the S&P 500 index. Now the question is, what now? Well, it feels like the good news do see some positive reaction from investors, and good earnings reports will likely help keeping the concerned sectors in demand. But the positive reaction that we see is more marked across the pockets of the market that benefit from lower market valuations, like sovereign bonds, for example, and the cyclical stocks, than the high valuation technology peers. And note that the S&P 500's equal weighted version, well, it recovered more than the normal weighted technology heavy version since the January 13th dip, and potential for a further convergence between the two remains the base case scenario of this year especially if the Fed expectations get softer and yields come lower. So this is all for this crazy week. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.